At 9:41 a.m., copper futures spiked 14% in under 6 minutes. No earthquake hit Chile. No miners walked off the job. Just a single offhand line from President Trump. We're doing copper, 50%. Within the hour, prices broke every chart on the COMEX, hitting an all-time high of $5.68 a pound. Not a bill, not a treasury release, just a microphone and a market panic. The U.S. imported $17 billion in copper last year. That copper runs through electric grids, EVs, chip fabs, aircraft, wind turbines. It's not just a raw material, it's the bloodstream of modern manufacturing, and 40% of what America uses comes from abroad, mostly from Chile and Mexico. When Trump declared a 50% tariff on all imports, the futures market didn't wait for clarification. The contradiction hit instantly. Trump claims he's rebuilding American industry, but the one input you can't build anything without, he just made it radically more expensive. According to the U.S. Geological Survey, the U.S. produces just 5% of global copper supply. And unlike oil, you can't drill your way to a solution. New copper mines take decades, an average of 22 to 29 years, to bring online, from permitting to production. Chile sends $6 billion in copper to the U.S. annually. Within 24 hours of Trump's announcement, Chilean Foreign Minister Alberto von Claveren told Reuters, Chilean copper will keep finding new markets. Mexico, too, is expected to reroute supply. Those new markets already exist. China. As of 2024, the majority of Latin American copper goes east, not north. This isn't speculation. It's logistics. China is the largest consumer of copper on Earth. When the U.S. exits a trade lane, China doesn't just absorb the slack, it gains leverage. For exporters like Chile, commodity margins are razor thin. A 50% tariff isn't absorbed. It redirects flow. Meanwhile, U.S. exports of industrial supplies, materials, and capital goods dropped 4% in May to $279 billion, according to the Commerce Department. That number hides the structural wound. The world isn't just buying less from the U.S. It's adjusting to a world where U.S. goods are no longer competitively priced. The copper tariff compounds the cost of every manufactured product that relies on wiring, motors, or heavy machinery. Japanese, German, and South Korean manufacturers looking to reshore operations into the U.S. now face a new risk unpredictability. The tariffs mean fixed costs have lost their meaning, and the firms that already relocated will be first to suffer. If your input metal just rose 50% and your local competitors in Vietnam, Malaysia, or China didn't, your board will demand answers. Consumer sentiment in the United States, already fragile, collapsed again in June. According to the University of Michigan's Consumer Confidence Index, sentiment has dropped at the fastest rate since 2008. That same indicator has preceded nearly every U.S. recession since World War II. And yet, the White House points to customs receipts as proof of success. In June alone, the U.S. government collected $27 billion in customs duties. That's up from $13 billion a year ago. The administration touts this as revenue recovery. But customs duty is not a surplus. It's a transfer from importers and consumers to the Treasury. And who pays it? Ultimately, the American buyer. Whether that buyer is a company or a household, the cost gets passed down, and that cost is rising fast. According to the Bureau of Labor Statistics, input prices for U.S. manufacturers jumped 6.4% in the second quarter, before the copper tariff takes effect on August 1st. That number is projected to rise by at least 3.2% more in the third quarter, driven mostly by raw materials and logistics constraints. In the first half of 2025, 379 large U.S. firms filed for bankruptcy. That's more than during the first 6 months of the 2020 pandemic. The Financial Times reports industrials and consumer discretionary firms accounted for over 60% of the filings. These are the sectors most exposed to input costs and export disruptions. Now they're the canaries. Meanwhile, China is positioning. On July 12th, an advisor to the People's Bank of China proposed a 1.5 trillion yuan, or $209 billion, stimulus aimed directly at domestic consumption. The plan includes rate cuts, currency flexibility, and infrastructure subsidies. In short, China is preparing to make its manufacturing even cheaper, and to keep domestic demand afloat while U.S. prices spiral. The yuan is already weakening, hovering near its lowest level in 16 months. But unlike the past, Beijing may now allow that slide to continue, leveraging it as a soft weapon to cushion exports against U.S. tariffs. According to Bloomberg, Chinese exports to Southeast Asia hit $53 billion in May, up 11% year-on-year. As the U.S. raises barriers, China deepens supply chains elsewhere. Let's pause, not for reflection, for reset. Because what Trump just triggered wasn't a tariff, it was a lever. And on the other end of that lever isn't China, it's Jerome Powell. Trump has openly called for Powell's resignation, conduct over renovations at the Fed's headquarters. But the subtext is clearer than ever. Trump wants rates cut, and Powell refuses. The real fight isn't between China and the U.S., it's between the White House and the Fed. Trump's plan is simple. Force Powell out, install a compliant chair, and drive rates down to 1%. That's not theory. It's what he told Fox Business. We should be 3 points lower, meaning near zero interest in a high inflation world. Deutsche Bank's George Saravelos warns this would trigger a persistent risk premium on U.S. assets. The dollar could fall 3 to 4% on a trade-weighted basis in 24 hours. Treasuries could sell off by 40 basis points. That's not just volatility. That's a vote of no confidence in U.S. monetary independence. The Fed is the cornerstone of dollar credibility. Undermining it invites systemic risk. ING analysts noted that Powell's removal could steepen the yield curve and trigger an exodus from long-term U.S. bonds. In a globalized market, perception of Fed autonomy determines risk appetite. And there's more. If Powell is removed, swap lines with other central banks may come under scrutiny. That could destabilize not just the dollar, but euro-dollar lending, emerging market liquidity, and sovereign debt pricing worldwide. Back in Washington, Trump's administration is mailing new tariff notices to allied governments. The latest is pharmaceuticals. There's a proposed 200% tariff on imported drugs, and it's currently under national security review. Australia's treasurer, Jim Chalmers, has already flagged the move as, well, very concerning. CSL, which is actually one of the largest drug exporters to the U.S., warned of major revenue impacts. And, this ties into another contradiction. Trump insists on reshoring essential industries. But these industries, semiconductors, biotech, metals, require complex global networks. You can't just slap 200% tariffs on insulin and then expect prices or availability to stabilize. As domestic costs rise, foreign demand retreats. U.S. exports to Latin America fell 5.7% last month. Exports to the EU fell 3.4%. And while the U.S. puts up walls, China is offering bridges. Through Belt and Road 2.0, Beijing is funding energy infrastructure across Southeast Asia, paid for in yuan or commodities. The long game here is dangerous. The copper tariff is just one front. The pharmaceutical threat is another. The Fed conflict is the deepest. But honestly, the result is the same, credibility erosion. And the data is shifting. According to the IMF's latest reserve report, the dollar now makes up 58.9% of global central bank reserves, down from 63% in 2020. The euro, yuan, and even gold holdings are up. Not dramatically, but steadily. That shift matters, because it determines who shows up at U.S. Treasury auctions. And this month's 10-year auction saw lower than expected foreign participation. The yield had to rise 12 basis points above forecast to fill demand. And here's the twist. Trump says he's using tariffs to fund America. And in a sense, that's true. But those customs receipts are now critical. Without them, the deficit balloons. And with falling foreign demand for U.S. debt, Washington must lean harder on domestic buyers, just as the Fed faces internal revolt. So the U.S. is taxing itself to fund itself, while simultaneously raising costs and lowering global demand for its goods. Meanwhile, China is absorbing copper shipments, weakening its currency, cutting rates, and building regional trade resilience. U.S. allies from Canada to Chile to Australia are openly discussing alternative markets. Even EU members are beginning to price in a post-dollar trade system, at least for commodities. The contradiction isn't that the US is collapsing, it's that it's choosing to bend the pillars that hold it up. Tariffs on raw materials raise production costs. Attacks on the Fed rattle bond markets. Export declines shrink global influence. And every time capital hesitates, China offers it somewhere else to go. This isn't de-dollarization, it's dollar doubt, and it's spreading. Quietly, methodically. The next move won't come from Beijing, it will come from within the US, either from markets or from policy. But one thing is now beyond hypothesis. A 50% copper tariff is not an economic policy. It's a signal flare, and every global institution, investor, and rival is watching what it means. The question is no longer will the US recover, it's how much damage will it choose to inflict before it does. Let me know what you think in the comments. If you've seen the numbers and they don't line up with the narrative, say so, because the numbers are real, and they're not finished moving. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.